this is what a bank should be doing. I'm going to take your money and I'm going to pay you an interest rate on it. Then you can take this piece of perfected collateral and you can take it around the DeFi Lego system and re-leverage it. You can trade with it. You can earn more yield with it if you want. But me as a bank, I just do something very simple. I just take your money and I let you send it from A to B very, very safely.
Hello everyone, this is BTC Insight and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
Hayes starts by pointing to what he sees as a coming tidal wave, trillions of dollars in stablecoin deposits flooding into the system. These stablecoins won't just sit idle. They'll circulate through markets, protocols, and exchanges, driving yields and reshaping how money moves. His thesis is that once stablecoins become the preferred vehicle for savings, payments, and trading, entire sectors of crypto will multiply in value. For instance, he predicts Athena could 51x, EtherFi around 34x, and Hyperliquid as much as 130x, because stablecoin users will seek leverage, yield, and opportunities directly on-chain. Why trade on-chain? Simply put, because they can. It's fast, it's global, and DeFi offers the high-yield, high-leverage products investors crave. In Hayes' view, the riskier parts of the curve, the projects generating real cash flows, will be the biggest winners of this adoption wave.
10 trillion of stablecoin deposits that would percolate around the markets. The protocols that I was shilling, Athena, I said it would 51x, basically based on people searching for higher yields in the treasury yield, going and using their synthetic dollar and the way that they're using the basis trade within Bitcoin to generate that yield. I think about a 34x improvement on EtherFi, as people now can spend the stable coins using their offline payment services and doing the sort of like banking services that EtherFi offers. And then Hyperliquid is something about 120 or 130x uplift, because it's going to become the largest exchange of any type globally now that you have all these people with stable coins who now want to trade on chain. Why do they want to trade on chain? Because they can. It's easy. High leverage, offers the type of products that they're interested in. So that's sort of where I want to focus in terms of obviously Bitcoin is going to do well. I don't know what that number is, but it'll be less than those in terms of the uplift. But sort of the riskier parts of the curve that'll benefit from this stablecoin adoption, I think, are these high cash flow generating DeFi projects. And the great thing about the zeitgeist now and sort of the investment community in the crypto space is that investors have punished projects that either A, never made any money, or B, made money but didn't give it to the token holders. And so if you're a project that is not buying back your token, is not giving back emissions to stakers, we as the crypto retail investor, or even some institutional investors, we don't want to touch it. I don't give a fuck if Sequoia and A16Z is on your cap table. Go fuck yourself. Where's my money? And so I think we're finally getting around to that ethos, and these projects that are going to do well are going to be paying us as the token holders for making them successful. Why is the Fed relevant? Because they set short-term rates. So they set the effective Fed funds rate. They have a band. They administer the interest on reserves, which is usually at the lower end of Fed funds. They also set the reverse repo rate, and which basically is at the high end of the Fed funds range. And if I'm a Treasury secretary and I'm issuing debt to some private institution who's a profit maximizing institution, well, if the Fed is offering a higher rate than what I am as the Treasury on a T-bill, then I'm just going to stick my money in the reverse repo with like a money market fund. Or if I'm a bank, I'm just going to lend it to the Fed at the interest on reserve. So I effectively, as a Treasury, cannot issue debt below where the Fed has the lower bound of the Fed funds rate. Now, if I have a stablecoin issuer who by law can only either A, put your money in the bank, which yields you almost nothing because too big to fail banks don't need deposits, they have enough, or you can buy a Treasury bill. You can't buy anything else. You can't put it in reverse repo. Can't buy any other newfangled securities. I've regulated you by law. These are the only two things you can do. Well, now, I can set the short-term rate wherever I want, because the marginal capital is not coming from money market funds. The marginal capital is coming from stablecoin issuers, and they want to earn a net interest margin, a yield on all these dollars that they have. And so they'll accept whatever yield I give them as Secretary Bessent. So if I think that the economy needs a 2% rate, okay, well, I'll sell T-bills at 2%. And there will be this effective Fed funds rate, assuming if I can't control the Fed governors. But in reality, the market's going to trade down at whatever 100 basis points below or whatever the number is. And so because these stable coins are regulated into buying the thing that I'm selling, I can sell it to you whatever price I want. And so another trick that they can employ to essentially neuter the Fed unless the Fed plays along and does what they want.
Of course, Hayes never leaves Bitcoin out of the picture. He emphasizes that Bitcoin remains the best performing asset class against currency debasement. When measured against gold, housing, or equities, Bitcoin has consistently outpaced them all. Traditional finance professionals, Hayes argues, believe in the same monetary realities as crypto natives. Central banks will always print money, governments will always debase currencies, and bonds have been the traditional hedge. But while TradFi sticks to bonds, crypto investors ride the faster horse, Bitcoin. From this perspective, short-term complaints about Bitcoin not hitting $150,000 overnight miss the point. Long-term holders have already outperformed virtually every asset in history. Patience, not speculation, is where the real wealth is built.
The commercial banking system will become irrelevant unless one or two of them adopt stablecoins, right? And this is why the whole fight about paying interest on them is a big thing. Because if I can easily pay interest as an issuer, why would I want a JP Morgan account? JP Morgan, I don't know what it pays, like 1.5%, 2% or something like that. I don't know. I don't have enough accounts, but I think that's around about the rate that you get as a depositor, JP or Citi or Wells Fargo, one of these large, too big to fail banks. But Fed funds is 4.25 to 4.5%, right? Money market fund yields much higher than that. And so the banks either have to raise their rates to match where the stable coin is, because now I can literally, with a click of two buttons, move my money. It's all digital money. You have a digital bank run into stable coins, or I have to raise my rates and reduce my profitability. Now, the best thing about a stablecoin issuer is that they don't have hundreds of thousands of useless employees doing all manner of bullshit, right? Yeah. Compliance is automated. KYC is automated. There is none of this legacy technology from the early 1990s percolating throughout your tech stack, which is a large bank. You don't have a bunch of fucking useless managing directors making $1 to $10 million a year scattered around your organization doing fuck all, right? So Tether is the most profitable bank in human history, making something, I don't know what the per employee numbers. I had an essay about it, but it's in the hundreds of millions, I think, per employee. They have something like 100 employees. So, this is what a bank should be doing. I'm going to take your money and I'm going to pay you an interest rate on it. Then you can take this piece of perfected collateral and you can take it around the DeFi Lego system and re-leverage it. You can trade with it. You can earn more yield with it if you want. But me as a bank, I just do something very simple. I just take your money and I let you send it from A to B very, very safely. That's what banks should do. They should be doing also the bullshit that we allow these banks to do in TradFi. And I can't wait for them all to be zeros. Bitcoin is the best performing asset when you think about currency debasement ever, right? Okay, yes, the S&P 500 is up in dollar terms, but deflate that by gold since 2009, the S&P has not recovered its gold price from 2008. Deflate the housing market by gold, again, and not anywhere close to where it was. Tech stocks are probably one of the only things that have big US tech is probably one of the only things that's done well, deflated by gold. If you deflate things by Bitcoin, it's not you can't even see it on the chart. It's just so ridiculous about how well Bitcoin has performed. So, I got asked this question, like, why is there a difference between TradFi and crypto? There's not. Actually, when you talk to a TradFi person and sort of really get down to what they believe, what do they believe? They believe the same things that we believe. They believe that when something happens, the Fed, the Treasury, the BOJ, the ECB, the PBOC, the SNB, they will print money. And what happens when they print money? They buy bonds. So in their mind, because they know bonds and they did a CFA or they went to business school, okay, well, if I buy the 10-year at 5% and it goes to 4% and I lever that 30 times, I become Ray Dalio, right? That's their mind. That's all he fucking did. He went long the fucking 30-year bond on leverage. That is interest rate parity. I can't fucking shit on them. Good on you, like, for running that fucking trade, but that's the trade. We all believe in the same things. It's just that crypto is the faster horse. Bitcoin has been the best performing asset on this currency debasement theme across any asset class. So it's not that we have a difference of opinion. We believe the same things. We believe the money will be printed. It's just that we in crypto choose an asset that performs better. And so if you take a very short time horizon, like, I don't know, from a couple months ago, and you say, oh, why isn't Bitcoin at 150,000? Well, I'm sorry that you bought Bitcoin 6 months ago, but for anyone who bought it 2, 3, 5, 10 years ago, they're laughing. Like, I don't give a fuck, right? I have so much outperformed the debasement of the dollar and every other fiat currency. Like, why am I like being all moody that, Bitcoin is not, hitting a new all-time high every day? It doesn't matter that the S&P is at 6,700 or whatever it is. It's still down in gold terms from the crisis. So I think people need to readjust their perspective on this. If you thought that you were going to buy Bitcoin and the next day you were buying a Lamborghini, you're probably getting liquidated, because it's just not the right way to think about things.
Arthur Hayes doesn't just speculate. He challenges us to rethink the fundamentals of finance. If stablecoins really do become a $10 trillion force, if DeFi continues to reward investors properly, and if Bitcoin keeps leading the race against debasement, then we're looking at a financial landscape radically different from today's. So what do you think? Are stablecoins the Treasury's secret weapon? Will banks become obsolete? And is Bitcoin truly the best performing asset of all time? Drop your thoughts in the comments below. If you enjoyed this breakdown of Arthur Hayes' outlook, make sure to like, subscribe, and hit that notification bell so you don't miss the next deep dive into the future of money.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.